U.S. nat gas futures traded above $2.10 on Friday, marking an over 8% increase for the week, supported by a return of warmer temperatures and positive reports. According to the U.S. Energy Information Administration, utilities added 21 billion cubic feet of gas to storage during the week ending August 2, and storage levels were 14.9% above the 5-year average, a decrease from 39% above in March and 19% in June. Meanwhile, gas production in the lower 48 states averaged 102.9 billion cubic feet per day in August so far, slightly down from 103.4 in July, but still below the record high of 105.5 set in December 2023. Looking ahead, major U.S. natural gas producers are planning to further reduce production in the latter half of 2024, after prices fell nearly 40% over the past 2 months. European nat gas futures hovered around an 8-month high of €40, poised for a 9% weekly increase amid concerns over gas supply stability following Ukraine's capture of the Sudza gas transit station in Russia's Kursk region. Despite the ongoing conflict near this critical transit hub, Russian gas continued to flow through Ukraine. Gazprom reported it would deliver 38.5 million cubic meters of gas to Europe via Ukraine on Friday, up slightly from 37.3 million the previous day. With the gas transit agreement set to expire at the end of the year, any early disruption could have a significant impact on Central European nations reliant on this supply. However, analysts believe that neither Russia nor Ukraine is likely to use the situation to halt gas deliveries, as both have incentives to keep the flow steady. However, with the transit agreement expiring at year's end, any premature disruption could severely impact Central European nations dependent on this supply. If European gas prices spike sharply, it could trigger a ripple effect in the U.S. market, potentially driving prices significantly higher. Significant changes in U.S. nat gas supply and demand are expected in 2025, potentially impacting prices at Henry Hub. A major increase in LNG export demand was anticipated, but delays in projects and a potential decline in gas-fired power generation have shifted bullish expectations to late 2025. As a result, we remain bearish for the first half of the year, but more optimistic for the latter half. The chart shows projected demand changes for 2025 year-over-year, indicating the supply growth needed to maintain balance. We forecast weaker negative demand growth in the first half, especially in the first quarter, due to a decline in gas power demand driven by renewable energy expansion. However, LNG feed gas demand growth is expected to offset this decline by the second half. Delays in LNG projects, including Golden Pass LNG, have postponed the shift in supply-demand balance to late 2025. We expect the first half to be weaker than current forecasts, with potential price support in the second half, though initial weakness could suppress prices before fundamentals improve. The chart displays average prices, but actual prices may spike during high-demand periods. Amid current market dynamics, the outlook for natural gas prices is optimistic. Traders should monitor the $2.30 level as a potential resistance point, with further gains likely if favorable conditions persist. Gas futures are expected to face resistance at $2.15. If prices break through this level with higher trading volume, it could pave the way for a test of the next minor peak at $2.30. However, if $2.15 is not surpassed, it may trigger renewed selling pressure, potentially driving prices back to a key support level at $2. Please like, subscribe, and comment to support the channel. See you in the next one.